Ladies and gentlemen, thank you for standing by and welcome to the Mastermyne Group Limited 2013 full year results teleconference. At this time, all participants are in a listen-only mode. There will be a presentation followed by question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this conference is being recorded today, Wednesday, 28th of August 2013. I would now like to hand the conference over to your first speaker today, Mr. Tony Caruso. Thank you. Please go ahead, sir.
Thank you, and welcome everybody to Mastermyne's full year results presentation. I've got with me here Chris Knight. Appreciate it's getting late in the day, so we'll hop straight into the presentation, and I'll ask you to turn to page 3 of the presentation, the results summary, where we'll start with the financial highlights. The revenue this year for the full year was $248.8 million, which was down 8.5% on where we were last year, but in the current environment, we see that as a very, very strong result, and as I say, only surpassed by the record result that we achieved in 2012. EBITDA was $18.5 million and was down predominantly because of two reasons, being the lower revenue in 2013 and also our asset utilisation, which we spoke quite extensively about at the half year, and that was predominantly around equipment that came off from the newsstand project. Our NPAT was 11.5, which was at the upper end of the guidance we gave in May, and the earnings per share 15.3 cents per share, down from the adjusted earning for the previous corresponding period of 21.1. Balance sheet, the net assets were up to $60.9 million, and net debt was down to $7.9 million, which is $3.2 million down on where we were in the previous corresponding period. The full final dividends for the year, 3.6 cents per share, taking the full year dividend to 6.9 cents per share, which is in line with our dividend policy of 40 to 60%, and actually represents a dividend payment of 45%, which is up on what we've previously paid. Our order book totals at this point in time, $236 million, of which $113 million of that will be delivered in 2014. And our tendering pipeline currently sits at just below $1 billion at $962 million, with $378 million of that in active tenders at the moment. Moving to page 4, the operational highlights. Through the year, we've continued the strong trend of improvement in our safety outcomes, and the standard industry measurement of total recordable injury frequency rate reduced to 3.28 for the full year, down from 4.67. And to put that in perspective, the industry comparable rate at the end of the December quarter, which was the last published results for the industry, was sitting between 8 and 9 between Queensland and New South Wales. So you can see that we're sitting well under half the industry average. During the year, we did 1.8 million man hours, which was slightly down on our man hours for last year. And in that period, in the period of the last 12 months, we've had 6 sites that have recorded a full year with no recordable injuries, which is quite exceptional performance. And when we talk total recordable injuries, it's a far more encompassing classification than what lost time injuries are. So we're very proud of that performance during the year. We've also, as we said at the beginning, maintained strong revenue in a challenging market, and most importantly, no loss of contracts other than what was scheduled to run off, particularly specifically the Kestrel Mine Extension Project and the Kestrel Drivage Project. And I'll talk to those a little bit more in the operational outlook and in the order book. But again, to make that point, whilst a lot of our competitors have seen significant downturn in their revenue, we've maintained all our contracts, which makes up our order book. Also, in the last few months, or in the later part of the second half, we've secured $65 million of revenue through 6 new contracts And 3 of those contracts were new projects and new sites, and 3 of those contracts were on existing sites where we were already working. And again, I'll provide some more detail of those new contracts later in the presentation in the order book slide. Also in our engineering and mine site divisions, we secured 2 new contracts and we renewed 2 other of our forward purchasing agreements in our engineering business, and I'll talk a little bit more to those later. Our workforce numbers are at 754 at the moment, and the majority of that change was from the scheduled runoff of the KME and Castrol drivage projects. And those 2 projects were the main contributors to the reduction in the overall manning numbers. And again, in the HR slide, I'll talk a little bit more about the overall reduction in the manning numbers on what was scheduled runoff versus what was contraction as a result of a lot of the cost cutting that we've seen in the mining services sector in the last 12 months. And the last point there was around that Kestrel mine extension project, which has now been completed and transferred to Rio's operational team from the 1st of July. And this was as scheduled and noted in our order book at the half year. Moving to page 6 to the financial overview, I'll hand over to Chris to take us through the next couple of slides.
Thanks, Tony. As Tony mentioned, revenue down 8.5% on our record year that we had last year in 2012, down to 248.8 million, and that's a result of the early contract completion at Newsdam, which impacted the second half. Net profit was down 26.8% as a result of the early contract completion and the lower asset utilisation that Tony mentioned before. EBITDA margins were therefore affected from those lower equipment utilisation as a result of the early completion of the Newsdam contract, and also our leases and depreciation of our training facilities, which were underutilised during the year as a result of the downturn as well. At the half year, I think we mentioned that we're expecting our margins to be down 2 to 2.5% on what we achieved in the first half of the year, and in the second half they were down to around about sort of 5.5%, which was roughly 3% reduction on what we'd had in the first half. So expectations going out to FY2014, where we stand at the moment, we're expecting them to be similar to what we achieved in the second half of FY2013, but there's potential upside depending on how that equipment utilisation improves during the year, which we have seen some of that equipment slowly start to come on at the back end of 2013, early 2014. As a result, full year dividends of 6.9 cents per share, which is down on 7.8 cents per share last year, but in line with our dividend policy of 40 to 65%. And typically we've paid down around that 40%, but we've paid a little bit higher this year than what we have in the past, 45% on the full year result. Turning over to slide number 7 on the divisional performance. So as mentioned, the underground division revenues and profits were down as a result of the early contract completion at Newsdam and the reduced utilisation of our equipment. Engineering revenues were down on FY12 as a result of a slowdown in the coal sector. Pleasingly though, they're not down as much as what we have seen them impacted in other years, and that's largely as a result of the increased consumable part of the business, which is tied to the production in the mines rather than the construction and maintenance phases. So that's been a pleasing result for those guys. Margins were down on where they were last year, and that's largely due to the volume of work and the lower revenues, and I guess the fixed cost base that they've got in their business that doesn't change that much as those volumes only move that 3 million that they have. The services division had a strong year, so it's well up on where it was this time last year, and that's largely as a result of that one contract that we had at the Rio Tinto site, having a full year effect of that contract coming through in 2013. Moving on to the working capital and cash flow, we had positive operating cash flows of 10.6 million for the full year, and working capital management, you can see they remain pretty steady. The results would have been a little bit better. They would have been $5 to $7 million better off in the movements to working capital, and then for the net operating cash flows. But as we'll see on the next page, the debtors haven't come down as much as what our payables have, in line with the reduction in revenues, and I'll just explain that a bit more on the next slide. That positive operating cash flow is offset by tax payments of $10.6 million, which is up as a result of payment in relation to the reversal of rights to future income tax, where we've had those normalising adjustments in our accounts in previous years that everyone's aware of. Net CapEx was low at $1.03 million for 2013. So obviously with the environment slowing down a little bit, we haven't spent much on CapEx in this year, but there still are opportunities out there, and I'll talk about the balance sheet on the next page, where we have got capacity to take on those opportunities if they become available. We repaid an extra $4 million in debt in the second half. The full year it's $6.3 million. We've paid down in debt, which is in line with what we've paid down in the past, but we did take on a little bit of extra debt in the first half. So with that extra cash, we have paid down an extra $4 million in the second half of 2013. And probably the only other thing worth of note is the acquisition of the training business during the year, which we did just before the end of the first half, which was $7 million net of the cash acquired. So looking at the balance sheet on page 9, as Tony mentioned, net assets are up to $60.9 million at the end of the year. Lower trade receivables and payables reflect these lower revenues. But as I mentioned on the previous slide, working capital would have been $5 to $7 million better off, and those debtors would have reduced more down around that $35 to $33 million. But they're just up slightly as a result of ramping up the couple of contracts we had down in the Hunter Valley in BHP. And as we've spoken about before, it's largely around those approval processes on those sites, and managing those approvals at the site level. Once it's in those client systems, they're pretty good payers. So we had those two projects down there starting off, and also we had the Rio Tinto contracts finishing up, which we've seen the payments for the final claims come through in the first half of 2014. As a result of paying down that debt and our cash remaining pretty stable, our net debt's decreased by $3.2 million to just under $8 million. And we've also seen that decrease in our current tax payable as a result of that $10.6 million in tax payments we made in the full year. And as a result, we've spoken about the balance sheet being in a good position and our net debt reducing. And as I mentioned on the previous page, we've paid a dividend of around about that 45%. And with a strong balance sheet, we have been looking at our capital management. What we can look at for our capital management over the next 12 months, whether we look at potentially special dividends or buybacks in whatever form that may be. So it is something that we will consider during the year based on the balance sheet that we've got.
Thanks, Chris. If I can move to page 11, just to talk through the HSEQ scorecard. As I mentioned, that TRIFR rate 3.28 was down from 4.7. And that's based on our internal reporting standard, which is much more stringent than the industry standard. And as I say, you're sitting at less than half of what the industry average is. Also mentioned the 6 sites recording the 12 months recordable injury free. During the year, we also received our certification for AS 4801 and 17001, which, as I say, is a strong endorsement for the business in terms of